Okay, we are going to start in 2 minutes' time.
Hello, Jamil. We are not sure whether you are talking. You are on mute. You've been on mute since the class started.
Oh, sorry. Okay, thank you, Shay. Okay, so what I was trying to do here is looking at the syllabus that you are supposed to use for the June 2021 examination, which is what we are all here for this morning. And there are about 6 main capabilities in the syllabus. The first one is apply fundamental ethical and professional principles to ethical dilemmas and discuss the consequences of unethical behavior. I said this will always be examined in question 2. Based on what the examiner has said and based on what we have seen in the last couple of years since SBR was introduced in 2018. Specifically, your examination questions is going to be structured in such a way that you will have section A and section B. In the section A of the question, there will be 2 questions. The first question will carry between 30 and 35 marks. In most cases, it carries 30 marks. But that 30 marks is going to be principally on group accounts. But it may not be entirely on group accounts. In question 2, the question 2 could be on any area of the syllabus, but it is in that question 2 that you are going to see professional ethics being examined. And that is what the A part of this syllabus talks to, which is the ethical and professional principles. The second aspect talks about to evaluate the appropriateness of the financial reporting framework and to critically discuss changes in accounting regulations. A number of accounting standards will be here, but specifically the financial reporting framework, which is a new document issued by the ISB in 2018, which became effective in 2020, is what they are talking about here. And that can be examined usually in the B part of the question. The B part of the question has 2 questions, and each one of them carries 25 marks each. And all the 4 questions must be attempted. So you have section A, 2 questions. The first one, 30 marks. The second one, 20 marks. You have section B, 2 questions. The first one, 25 marks, and the second one, 25 marks. So this B can be examined in question 3 or question 4. The third one is to apply professional judgment in the reporting of financial performance of a range of entities. A number of accounting standards, virtually all the standards we have, exception of group account related standards, will be examined here. Please let's adhere strictly to the protocols and the rule here. Everyone should go on mute. If you want to speak, please feel free to raise your hand. You will be called to speak. The fourth one is to prepare the financial statement for a group of entities. That is group accounts. A number of group account related standards will be examined here. And I've mentioned that mainly in question 1, but we've seen instances where group account related standards are examined in question 2 and in question 3 as well. Interpret financial statement for different stakeholders. You can interpret financial statement by using ratios, and you can also interpret financial statement without using ratios. And this is something that can be examined in any part of the syllabus. To interpret financial statement for different stakeholders, like I've said, can be examined in any part of the questions. And lastly, to communicate the impact of changes and potential changes in accounting regulation and financial reporting. This will touch on 2 different areas. You can be looking at IFRS 1, which is first-time adoption of IFRS here, and that is for an entity that is just adopting IFRS. Then secondly, you may be looking at an entity that has started using IFRS, but possibly that entity is changing its accounting policy with regards to certain transactions. Also, that entity will apply IAS 8, effect of accounting policies, changes in accounting estimates, and correction of error to be able to deal with that. These are the various aspects of the syllabus, the 6 capability areas I won't want to really go into the detail of this, considering the volume of what we have to do. I'm sure we all have access to this. If not, the WhatsApp group that has been curated, this can be sent across to all of you to guide us and in preparing for this examination. So this part talks to the changes that occurred in this syllabus, which is not really material as such. The other document I would like to share with you also is the examinable document. And the examinable document I'm talking about is the one I presented before. Now, lest I forget, for this paper called SBR, there is an international version and there is also the UK version. However, the expectation is that based on what we've taught in Ivy League, we've really taught our students based on international version. And the expectation is that everyone on this session, attending this session today, we believe that you are actually sitting for the international version of the exam. As such, our focus is going to be on the international version. However, I'm sure for those who are doing the UK version, there are a whole number of areas where the questions will look identical. Now, what this examinable document shows is the various accounting standards that will be examined in this paper. Which accounting standards will be examined? And if you look at the way it's been organized, you have the first column, which is for financial reporting on the right side. And what that is telling you is this accounting standard they take here will be examined or has been examined in FR. The expectation ideally is that everyone writing this paper will have done financial reporting. However, we understand that there could be a number of people who are writing this exam that will not have done financial reporting as well. And as such, but if that is the case, you will have been, for the ACCA to have exempted you from FR, it shows that you have actually done the equivalent of that, maybe in another professional examination you've written, or maybe you did that in your school, in the higher institution. That could have been the reason why the ACCA will have exempted you. So the second column, which is the last column here, is for SBR, and it shows the various accounting. It shows what is relevant. You can see IS1 financial statement presentation is relevant. IS2 inventory is relevant, but this is a standard that will have been examined in the elementary part of the paper, in FR to be specific. And virtually everything you will have done in FR. So usually in SBR, we don't really emphasize this paper. Statement of cash flows. What you will have done in FR will have been the basic one. But in SBR, the focus is on the group, how to prepare financial statement for a group of entities. That is consolidated statement of cash flow. That is the main focus here. IS8, you will have done it in FR, but in SBR, the main focus is how it will be examined, the way FR is examined, the way these accounting standards are examined in FR is different from the way they are examined in XBR. In SBR, you are expected to really write like a consultant. who is providing advice to the stakeholders. And those stakeholders, some of them may be accountants, some of them may not be accountants. The expectation of the XBR examiner is that you should write from the perspective of the stakeholders. So IS8 has been examined in FR, but it will be examined in a much more detail in this SBR. And you know, IS8 focuses on 3 different areas. The accounting policies, change in accounting estimates, and correction of error. IS10 has been examined in FR. It can be examined in SBR, but in a much advanced way. The focus of IAS10 that we all know is that it talks about events after reporting period. It talks about those events, classifying those events into 2, adjusting and non-adjusting. The adjusting provides further evidence of conditions that existed at the reporting day, while non-adjusting is just indicative of events that arose subsequent to the end of the year. IAS 12 is examined in a much detailed level in this paper. IAS 12 deals with income taxes, which consist of current tax and deferred tax. And IAS 12 is examined in a much detail here. IAS 16 has been fully examined in FR. So virtually everything you know in FR is what has been repeated in SBR, but in a very much detail. Employee benefit is a standard, which is IS 19, that you will not have done in FR. So it is only being taught in SBR. And that shows that it's a new standard. That knowledge will not have been acquired in FR. So it's a very important accounting standard. IS 20, which deals with government grants, is something you will have equally done in FR. But in SBR, that knowledge is assumed. You know that IS 20, when it comes to grants can be divided into revenue grant and capital grant. Revenue grant is recognized in P or L unless you have not met the condition, in which case you have to put it in a liability and actually amortize it over the period. If you look at revenue grant that you are putting in under liability, it doesn't really mean the definition of a liability, but the only place where you could present it on the face of the statement of financial position is to put it there. When it comes to capital grants, you know that capital grants, there are 2 approaches in terms of the way it can be presented. One is to credit it directly to the related PP, and the other one is to actually set it up as a deferred income, and it will be amortized to P or L. IS 21, effect of changes in foreign exchange rates, is been examined in FR, is been examined here. It's one of the standards I will talk about today. So I will jump that to IS 23, borrowing costs. Borrowing costs has been examined both in IFR and now in this SBR. And you know, borrowing costs is simply telling you that borrowing costs that meets the definition of that are incurred on qualifying assets should be capitalized. All other borrowing costs should be expensed. The related party IS-24 is something that is being taught for the first time in SBR, and it's a disclosure standard. So you need to identify who is a related party, and you should be able to identify what should be disclosed. So being able to identify the related party is the main focus of that standard. IS-27 deals with separate financial statements. And again, this is something that is part of the group, although it has nothing to do with group account. The financial statement of the parent, where the subsidiaries are not consolidated, is what we refer to as separate financial statement. So the focus of IS-27 is very narrow. It's very narrow. An examiner highly examines it. There is another thing in IS-27 that deals with group reorganization. That is something that could be examined by the examiner. Is there in IS-27. IS-28 deals with investment in associate and joint arrangement. Is one of the standards I will talk about on the slide. IS-32 deals with financial instrument presentation. Is one of the standards I will talk about in the slide. EPS, earnings per share, is another important standard but this has been fully taught in FR. So that knowledge is assumed here. We hardly really teach it as such. I-34, this with interim financial reporting, is a standard that has never been taught in FR, but here you are being taught for the first time, and it's basically focusing on interim financial statement, which could be a quarterly financial statement, or which could be a financial statement that is prepared for half year, which is a 6-month period. I-36 has been examined in FR and is being examined in much detail here. I-37 likewise examined in FR, but it's been examined in much detail here. Intangible assets examined in FR is being examined in detail here. I-41 agriculture likewise been examined in detail here. IFRS 1 is being examined for the first time in SBR. IFRS 2 share-based payments, which tells you that you have equity settled, the cash settled share-based payment, is being examined for the first time in SBR. Then you move to IFRS 3, which is business combination, one of the standards I will talk about shortly. IFRS 5, non-current asset held for sale and discontinued operation, has been examined in FR, is being examined in much detail here. Financial instrument disclosure has been examined in FR, it's been examined here, but it's a disclosure standards, and for that purpose, examiner hardly focus on that IFRS 7. IFRS 8 operating segment is being taught for the first time in SBR, and it's a standard that talks about operating segments. It's a standard that should only be used by entities that are listed, but for entities that are not listed, if they want to use it, they are welcome to use it. But it's about the disclosures to be made in the financial statements for entities that have different segments. IFRS 9 is a standard that is being examined in much detail level at this standard. IFRS 10 consolidated financial statements are being examined in much detail in SBR. IFRS 11 being examined for the first time in SBR. IFRS 12 is a disclosure standard as well, and for that purpose, the examiner hardly focused on that. IFRS 13 fair value measurement is examined, would be examined in much detail in this paper. IFRS 15 revenue will be examined in much detail in this paper. Likewise, IFRS 16 leases. IFRS for SME being examined for the first time in the SBR. These are the other documents. You have the conceptual framework that is contained in our handouts, the integrated reporting, and then you have the other things that could be considered to be current issues. My colleague will come in later in the day, maybe around 3 o'clock, to take some of these, especially the current issues, which represent the exposure drafts that have been highlighted here. So that is about the examinable document. Again, this is a document I expect everyone to have. But in case you do not have it, it's something that can be shared to really guide the way you are going to revise this paper. Having said that, I would like to move back to the slide I was trying to project before. Okay. I'm sure you are not yet seeing my. Okay, I have multiple internet connection here. So I will switch once I notice that this is slowing me down. I'm going to change. Okay, because of the volume of what we have in SBR, we are not likely to touch on all the accounting standards and the different areas of the syllabus today. So what we are planning to do is to, restrict ourselves to what we believe we can cover. Like I've said, I'm going to cover some of this, and my colleague will equally come in later in the day, maybe by 3 o'clock Nigerian time, to cover some of this. I'm going to be focusing on group accounts and all the related accounting standards. I'm going to equally focus on 3 core accounting standards that are very important to you, aside from those group accounts related standards. So the other 3 core accounting standards I will focus on will be financial instruments. And you will see that there will be about 3 accounting standards under that. The second one will be on IFRS 15 revenue. And the third one will be on IFRS 16 leases. So those will be my focus for the purpose of this revision. Those will be my focus for the purpose of the revision. As already mentioned before, feel free to raise your hand if you have any question. You will be asked to speak. You will be invited to talk and to clear your point that you may have. Okay. IFRS group accounts. What we call group accounts, we have a number of accounting standards that actually that are being examined here. The first one is IFRS 3 business combination, and the second one is IFRS 10 consolidated financial statement. Under IFRS 10, you have some key definitions. Then the second thing is, so key definitions such as what is group, what is consolidated financial statement, what is parent, what is subsidiaries. Nobody is going to ask you to define all this at this level anymore. One of the items that has been defined here is control. And control, you were told it has 3 elements. Aside from that, you have exemption from preparing consolidated financial statements, meaning those 4 conditions that if you are able to meet them, as a parent, you can choose not to prepare consolidated financial statements. Also, exclusion of a subsidiary from consolidation. Here, what we are trying to do is to find out whether it's possible under IFRS 10 to exclude a subsidiary from consolidation. The conclusion is only when control of a subsidiary is lost. That is when you can choose not to consolidate the subsidiary. IFRS 10 talks about the accounting date, the fact that the year end of the parent and that of the subsidiary should be the same. But it tells us that what we should do when the year end of both of them are not the same. It equally tells us that the accounting policies selected by the subsidiary and the parent for the purpose of preparing consolidated financial statements should be the same. But when they are not the same, what should you do? Definitely the financial statement of the subsidiary will have to be adjusted for the purpose of consolidation to ensure that the accounting policy of the group remain the same. Acquisition that does not result into a change in control. So before that, you learn how to prepare consolidated financial statement. You learn how to prepare consolidated statement of financial position, under which you learn how to calculate goodwill, or the opposite of that, which is what we call gain from bargain purchase. In ACCA exam, that is often referred to as negative goodwill. If it is goodwill, is shown as an asset, but if it is the opposite of that, which is what we call negative goodwill, after you have examined the items you use to compute that, you have to present it in the statement of P&L as an income. You learned how to calculate, determine NCI at the reporting date for the purpose of inclusion in the SFP. You learned how to do the net asset of the subsidiary, which will help you to separate the net asset into the net asset at the reporting date, the net asset at the acquisition date, and you're able to get your post-acquisition retained earning, and also post-acquisition other component of equity. You equally learned how to determine consolidated retained earning for the purpose of inclusion in the consolidated SFP. And you learned a number of things under that, including all the intra-group adjustments, the measurement period, and several things. That, although measurement period is under IFRS 3. Then acquisition that does not result into change in control. That is, when you already have control and you acquired additional interest in the subsidiary, you learned how to prepare consolidated financial statement in that scenario. The disposal of interest in subsidiary, the 3 scenarios, that is when you do full disposal, when you do partial disposal. For instance, when you have 80% and you sold the entire 80% and you are left with nothing. Also, you have another scenario where you have 80% and you sold, say, 50%, and you are left with about 30%, which could be accounted for as an associate or JV. And also you learned another one where you have 80%. For instance, you sold 70% and you are left with 10%, which is just an ordinary investment to be accounted for under IFRS 9 financial instrument. And likewise, disposal that does not result into change in control. When you have 80% and you sold 10% out of that and you are left with 70%, that is what we refer to as a disposal that does not result into change in control. Each one of these aspects of disposal have unique way of dealing with it. Each one of them has a unique way of dealing with it. And this you must have learned under the IFRS 10. IFRS 3 is the one that deals with business combination, which can be structured in different ways. But in most cases, the examiner of SBR is often interested in business combination structured in such a way that it creates parent-subsidiary relationship. So you look at what is a business, what is not a business, what is a business combination, and what is not a business combination. Those are part of what you learned under IFRS 3. And the amendment that was done to IFRS 3 recently, which changed the definition of a business, was equally part of what you must have learned before now. You dealt with acquisition accounting. Acquisition accounting has 4 focus areas. The first one is to identify the acquirer, which is the one that acquires the other one. The second one is to determine the acquisition date, which is very important you determine for a number of reasons. For a number of reasons. You need to determine acquisition date so that the consideration you are giving as the acquirer will be measured at fair value at the date of acquisition. Also, the assets and liabilities of the acquiree, the subsidiary, need to be measured at fair value. But fair value as at which date? Fair value at the date of acquisition. Likewise, the reserve in the books of the acquiree, the subsidiary, at the date of acquisition will be regarded as pre-acquisition reserve. Subsequent profit made after that day will be regarded as post-acquisition retained earning. So you have a number of reasons for you to identify the acquisition date. The third aspect of acquisition accounting is actually loaded with a number of things, and that is the one that talks about you recognize and measure the identifiable assets acquired. That is first. The second one, it is assumed, and the assets and liabilities within the scope of those 4 standards should not be measured at fair value at the date of acquisition. Rather, they should be measured in accordance with the requirements of those standards. And you also did a number of other things under that. There you did measurement period, and there you look at the various components of consideration, one of which is deferred consideration, another one which is contingent consideration. Contingent consideration is something that should be measured at fair value at acquisition date. And depending on whether it's equity or liability, if it's an equity, it will not be subsequently measured. But if it is a liability, it should be subsequently measured at fair value. So where the fair value gain or loss will be reported, in most cases is P or L. But there are a number of other things that you learn there. Intangible asset of the subsidiary not previously recognized. You were told to recognize it if the fair value can be measured reliably. The contingent liability of the subsidiary not previously recognized. You were told to recognize it if the fair value can be measured reliably. And you also learned how to measure NCI, and you were told that NCI should be measured using either of 2 approaches, depending on what the examiner wants you to use. One, you can use fair value method, otherwise known as full goodwill method. Number 2, you can use proportion of net asset method, otherwise known as partial goodwill method. Nicholas, your hand is up. Can you please go ahead to ask your question?
Are you hearing this?
I can hear you, but your voice is breaking. I don't know whether it's my network or yours.
Am I clear now?
The voice is. I'm assuming it's not my network. Can others hear me clearly when I was talking the other time?
Yeah, we can hear you clearly.
Yes,
We
we
can
can
hear
hear
your
you.
voice breaking. Yeah.
Okay, so Nicholas, I guess is your network.
Can I write something? I'm asking if you're sharing anything because I cannot see anything being shared.
Wow, I'm actually sharing. I'm sharing a slide. I guess the reason you
Yes,
cannot
now
see.
I can see it now.
Okay, that is
Yeah, I
fine.
can see it
Thank
now.
you.
Thank you,
You
thank
can
you,
go
thank you.
back in. Okay. Then we also learned how to calculate goodwill, or what we call negative goodwill. It cannot result into goodwill and negative goodwill at the same time when you acquire a subsidiary. It's either you have goodwill or you have a negative goodwill, otherwise known as gain from bargain purchase. The real name mentioned in the standard is gain from bargain purchase, but in the ACCA world, we've come to recognize it as what? As negative goodwill. So just the same way that you have two methods for NCI, you also have two methods for goodwill. And the examiner will make it clear to you, directly or indirectly, the method he wants you to use. And that method could either be fair value method. If you use fair value method for NCI, that is the method you must use for goodwill. And if you use proportion of net asset method for NCI, that is the method you must use for what? For goodwill. Part of what we learned under group accounts, which is actually not IFRS 3 specific, is how to test subsidiary for impairment as a cash generating unit, applying the principle of IAS 36. And the peculiar thing you need to know here is, if you are using fair value method, the goodwill you have in your book is full. It belongs to both parties. It belongs to both parties. And which parties am I talking about? The parent and the minority shareholders, called non-controlling interest, NCI. So that goodwill is fine. It's pretty simple. You are using it in that impairment test. Recall that you are comparing the recoverable amount, which is the higher of two figures, fair value less cost of disposal or value in use. You are comparing it with the carrying amount of the subsidiary. So what will be the carrying amount of the subsidiary? It will be the net asset of that subsidiary at the impairment testing date, plus the goodwill you have on that subsidiary as at that date, at the impairment testing date. So if you are using fair value method, you put the entire goodwill there. But if you are using proportion of net asset method, it shows that the goodwill you have there only belongs to the parent company. So you have to derive the goodwill that belongs to NCI, which is not recorded in the book, but you have to bring it into that calculation. Part of what we did in group accounts under IFRS 3 is what we call step acquisition or piecemeal acquisition. Piecemeal acquisition occurs when the initial percentage you acquired is, say, 10%, and subsequently you acquired additional 60%, and cumulatively you have 70%. NCI becomes 30% in that case. That is one scenario. This is what we call from ordinary investment under IFRS 9 to what? To a subsidiary. Because initially you had 10%, you acquired additional 60%, and cumulatively you have 70%. It is on the day you gain control, which is when you acquire the second 60%, that you are going to apply acquisition accounting. But the previously acquired 10% should be measured at fair value. And where the fair value gain or loss goes to depends on how you have accounted for that 10% previously, either fair value, either it goes to P or L if previously it's been accounted for at fair value through P or L, or it goes to OCI if previously it's been accounted for as fair value through OCI. The other scenario, Omotayo, I'm coming back to you. The second scenario is when you have 30% before, perhaps you will have accounted for this as an associate or JV under IS 28, and you acquired additional 40%. Cumulatively, you have 70% now, and NCI becomes what? It becomes 30%. At the day you gain 40%, that is the day you gain control. That is the day acquisition accounting will be applied. But the previously acquired 30% should be measured at fair value as at that day that you gain 40%. And the difference between that fair value and the carrying amount of that previously acquired 30% will be recognized in P or L. So those are the things we did under IFRS 3, business combination. Omotayo or Dekunle, your hand is up, please go ahead.
Okay, good morning, Jamil. So can you please come again on this impairment using when you are using partial Goodwill method, the impairment on CGU?
Okay, I said if your goodwill has been calculated using fair value method, otherwise known as full goodwill method, we are going to say recoverable value or recoverable amount, which the examiner will give to you, right? Then you compare that with the carrying amount. What will be the carrying amount? The summation of A and B. What is A? The net asset of the subsidiary at the impairment testing date. The net asset of the subsidiary at the impairment testing date. What is B? Your B should be the goodwill as at that reporting date. If part of it has impaired before, it means the goodwill at that impairment testing day will be lower than the one you have at the date of acquisition. Now, if that goodwill has been computed using fair value method, it is that absolute goodwill you are going to add to A. But if that goodwill has been computed using what we call proportion of net asset method, let us assume the goodwill you have in your book is $160. And this goodwill has been computed using proportion of net asset method. The question is, what is the percentage that parent has? Assuming parent has 80% interest in that subsidiary, it means the goodwill you have here of 160, given that it's been computed using proportion of net asset method, belongs to only the parent company. But you cannot use that goodwill that belongs to parent company alone. What you need to do is to divide it by 80, which is the percentage of parent company that has that goodwill, multiply by 20, which is the percentage of NCI. I'm sure if you do that, you should get 40, right? 40. So the total, this is the goodwill of NCI goodwill, but it's derived, it's not in the book. It's derived, it's not in the book, NCI goodwill. So the total goodwill you will have in the consolidated financial statement will be 160. For the impairment test, will be 160 for the parent, and for the NCI, it is going to be 40. And the summation of the two is going to be 200. So your B here is now 200. But that 200, take note, it consists of goodwill of 160, calculated using proportion of net asset method, which is the goodwill in the book that belongs to parent company. But the goodwill of 40 is the derived goodwill of NCI, which is not in the books, but which you have to derive and add to the 160 before you can do that impairment test. So exactly the point I was trying to explain the other time. I hope that is clear, Odekunle Omotayo.
Yes, it is. Thank you.
Arit, your hand is up, please. Go ahead.
Okay, sorry, I missed something out. For piecemeal acquisition, the 30%, of course, like you mentioned, you're going to fair value it, add the fair value when you gain control finally after getting the 40%. You're going to fair value the 30% as at that date of gaining control. But the 10%, what do you do to the 10%? Do you still fair value the 10% at the date of gaining control, since it was a simple investment?
Okay. You know, there are two scenarios I painted here. The first one where you have 10% is the first scenario. And the second one where you initially have 30% is the second scenario. The same thing will be done under the two scenarios. On the day you gain control in the case of the first scenario, which is when you acquired this 60%, that is the day you gain control. That is the day you will apply acquisition accounting. That is the day you will treat that entity as a subsidiary. That is the day you will calculate goodwill. The previously acquired 10% should be measured at fair value as at that day that you gain control. So any difference between that fair value and the carrying amount of that 10% in your book immediately before you gain control should be treated either as fair value through P or L or as fair value through OCI, depending on the accounting policy that you, under IFRS 9 that you've been applying to that 10%. I hope that is clear.
Yes, thank you.
Thank you. You can go back on mute. Samuel, your hand is up. Please go ahead.
Hi, Jamil. Just wanted to confirm my understanding, particularly regards to the impairment of a subsidiary. So you had said that when we use the partial goodwill method, right, in calculating the impairment, you will need to reverse it to the notional total goodwill, right?
Yes.
Right. So my question is, if you do that revision and then you get the total impairment loss, and then you have to reallocate the portion that relates to the group, right? If that reallocation is higher than what was originally calculated in the account as goodwill, if that impairment loss is higher than what we already have in the account as goodwill, that excess, how do you treat that excess?
If I get your point right, let me put it down here. Okay, let me use this place. I don't want to bring in a new slide. Let us assume that you're carrying your recoverable value is, say, 300, right? You have your net assets at impairment testing date. Let's assume it is 100. I hope I will not change the figure. Then the goodwill, the one for the parent is 160. The one for NCI derived is 40. You add the two together, it gives you 300, right? So your carrying amount is 400. So you are looking at a scenario where our impairment test is higher than the goodwill, right? That is what you are looking at, right?
Yes, yes.
Impairment loss. I will change the figure to achieve that. So let us assume that the net asset of the subsidiary at impairment testing date is let's say 500. Let's say 500. So when you add 500 to 300, you have 800 here, right? 800. So 300 minus 800 is 500. Is that not? So our impairment loss is 500. Is that not? 500. Okay, this is the scenario you are looking at. Correct me if I'm wrong.
Yeah, that's correct.
Impairment loss is greater than the NCI. Okay, greater than the goodwill. So in terms of allocation under IAS 36, remember, when you start allocating, allocation under IAS 36, you will say first to what? Goodwill, right? No obviously impaired assets, so goodwill takes first. So when you allocate to Goodwill, you say 300, right? So you are left with 200, right? Then that 200 you allocate to, you will say second, to remaining assets on what? On pro rata basis, right? Which is the 200. Okay, so, and the goodwill is gone, fully gone, right? The goodwill is fully gone. But take note, in recording, when you are recognizing the impairment loss relating to that goodwill, you are not going to record the impairment loss of 300 in your books. You know why? You will only record the impairment loss of 160. Because the faulty goodwill of NCI is notional, it's only derived for the purpose of this test. It is not in the books. It is not in the book. So in terms of recognizing impairment loss in your books, you are only recognizing impairment loss of 160. But you have it at the back of your mind that the notional goodwill of NCI is equally fully gone, is fully impaired. But you will not record it because that goodwill of NCI was never recorded in your book in the first place. I hope that is clear.
Yeah, it is. Thank you.
You're welcome. Go back on mute. Tokwe, your hand is up. Tokwe, can you go ahead, please? Your hand is up. Can you unmute yourself and speak? You are mute. We can't hear you. Okay, so we can't hear you. You are mute. Then let me call the next person, Victoria Obanyi. Your hand is up, please. Go ahead and speak.
Okay, I just wanted to ask how you get the notional goodwill or the goodwill for the NCI.
You know, I derived it the other on the previous slide. I said assuming parent has 80%. And the goodwill of the parent calculated using proportion of net asset method is 160, assuming. So if you now want to derive goodwill of NCI, you will say that 160 divided by the percentage of the parents, which is 80, then multiply by the percentage of NCI, which is 20. And I'm sure that will give you 40. That is how I derive it. That is how we derive it. That is how we always derive it. I'm sure that is clear, right?
Yes, thank you.
Okay. The other thing that you have under IAS, under group accounts, include IAS 21. IAS 21 is not purely group account standard, but it has elements that deals with group account. Israel, your hand is up, please. Can you go ahead?
Sorry, I wanted to, the scenario you painted is for proportionate of net asset method. What if it's the fair value method? What would be the treatment?
If it is fair value method, like I've said repeatedly, assuming the goodwill you arrived at when you calculated the goodwill was, let's say, 180, right? 180. That is the goodwill you have. That goodwill, because you have used fair value method, is partly the goodwill that belongs to parent and partly the goodwill that belongs to NCI. So when you are including it in this calculation, are we together? You can see I struck out the 160 and 40. You will just put that 180 here. Are we together? You will put the 180 and you will add it to the net asset. And what you will have will now be 500 plus 180, which will be what? It will be 680. So there is nothing like you deriving NCI goodwill, because the goodwill of 180 you have also already includes that of NCI. I'm sure that is clear, right?
Yes, thank you.
Victoria, I believe the hand I'm seeing is still the old one. You can lower it if it's the old one. Okay, IAS 21 deals with effect of changes in foreign exchange rate. And there are three aspects it deals with. The first one is functional and presentation currency. Presentation currency is the currency in which your financial statement is presented, while functional currency is the currency of the primary economic environment where the entity operates. IS 21 will tell you that you need to identify your functional currency using three factors, right? Which I'm sure you guys have all learned. But if those first three cannot help you, then you should identify your functional currency using two additional factors. Using two additional factors. If you're able to identify your functional currency using the first three, there is no point using the last two. The first three include one, the currency that influences the sales price of the goods or services. The second one says the currency of the country whose regulation and competitive forces influence the sales price of the goods or services. And the third one is the currency in which material costs, labor costs, and overhead are denominated. If you're able to identify your functional currency using those first three, there's no point using the additional two. But if not, then you use the additional two. And the additional two are one, the currency in which your fund from operation is retained, and lastly, the currency in which you raise finance if you are raising finance. Those are it. Then after that, we also look at if you are dealing with the subsidiary of a multinational company, there are four additional factors you consider that should complement those ones that we've mentioned. We talked about foreign currency transaction. On the date of the transaction, you were told to use the spot rate as at that date to translate it into your functional currency. At the reporting date, before the reporting date, if settlement occurs, if you settle the receivable, if you settle the payable, or you collect the receivable denominated in foreign currency, you should use the exchange rate at the date of settlement. And definitely that will be different from the exchange rate at the date of the transaction. And the difference, exchange difference, we go to P/L. And that is what we call realized exchange difference. Then when it comes to the year-end balances means settlement has not taken place at the end of the year. You still have assets and liabilities denominated in foreign currency. For those year-end balances, you need to separate them into monetary and non-monetary. For the monetary, you translate them using closing rate, which is the rate ruling at the reporting date. Any difference between that rate and the rate at which that item was initially recorded in your book will be recognized directly in P/L as a gain or as a loss. That is an unrealized exchange gain. Monetary items include cash, receivables, payables. Then when it comes to non-monetary items, those ones you separate them into two. Those measured at historical cost, and two, those measured at fair value. If you are looking at those measured at historical cost, property, plant, and equipment carried under historical cost will fall in that category. Investment property under cost will fall in that category. Intangible under cost model will fall there. Inventory carried at cost will fall there. But when you are looking at those measured at fair value, you actually measure them. Those include PP carry under, PP means property, plant, and equipment, carried under evaluation model. Intangible asset carried under fair value model. Investment property carried under fair value model. Inventory carried at net realizable value will be in that category. And investment in equity carried under fair value model will be in that category. So for those measured at cost, non-monetary item measured at cost, the exchange rate you continue to apply is the exchange rate at the day you first recorded the item. And in that case, there won't be any exchange difference. But for those measured at cost, the exchange difference you will have to apply the exchange rate, sorry, for those measured at fair value, the exchange rate you apply is the exchange rate at the date of determining the fair value. And definitely the exchange rate will be different from the one applied when the item was first recorded in your book. Any difference between that and that exchange difference, we go to your P&L. Sorry, it will go to your P&L or OCI, depending on where the fair value gain or loss on that item goes to. Okay, then thereafter we moved to foreign operation. Foreign operation could be a foreign branch, a foreign subsidiary, a foreign associate, or a foreign joint venture. But the main focus was a foreign subsidiary. And there you learned a lot of things. You were told that when you are consolidating a foreign subsidiary, whose functional currency is different from the functional and presentation currency of the group. The assets and liabilities of the subsidiary should be translated using closing rates. Income and expenses in the statement of P&L should be translated using average rates. All pre-acquisition items under equity, which include the share capital, the share premium, the share capital, the share premium, and the pre-acquisition return and the fair value adjustment, they should be translated using the exchange rate at the date of determining the of acquisition, at the date of acquisition. Post-acquisition return will be translated using average rate. Then there will be a balancing figure, which is an exchange difference. Also, goodwill that you have on that subsidiary should be retranslated at the end of every year. Take note of that. That is very important. That goodwill must be retranslated at the end of every year. And the difference will be recognized as part of the exchange difference in OCI. It should be recognized as part of the exchange difference in OCI. There's a way we calculate the exchange difference. Possibly we'll solve a question now and see how to apply that. Group statement of cash flow is really a whole lot of things. There are some things that are basic and there are some things that are specific to group statement of cash flows, such as how do you determine dividend paid to NCI, which is one area that we paid attention to. How do you, when you acquire a subsidiary during the year, what will be your cash consideration, which we said it should be the cash you pay less the cash that subsidiary brought to you. But also when you are determining cash movement on assets and liabilities, you need to take cognizance of the fact that you acquired a subsidiary during the year and the assets and liabilities of the subsidiary should be fixed into wherever you are trying to determine the movement in those assets. Likewise, when you dispose a subsidiary during the year, your cash inflow is the cash proceed, less the cash that subsidiary goes away with. In that case, again, when you are looking at movement in the assets and liabilities, you need to take into consideration the fact that that subsidiary is going away with some assets and liabilities at the date if departing the group. Aside from that, if you have investment in associates or JV, what will be the cash flow items? The additional investment you make in the associate in form of cash is a cash flow item to be shown under investing. The dividend you received from the associate or JV will be shown under investing activities. When you acquired interest in a subsidiary and there is no change in control, or you sell your interest in subsidiary and there is no change in control, the cash you received when you sell or the cash that you pay when you buy in the statement of cash flow will be shown under financing. Under financing, not under investing activities. Those are some of the key things that we learned under step 7. Samuel, your hand is up.
Yeah, so sorry, I just wanted to confirm again. Is it not possible that an entity will have a transaction in a foreign currency, and that foreign currency of transaction is different from the functional currency. And then the entity also prepares account in a different currency. So, for instance, you conduct transactions in pounds, and your functional currency is the dollar, and you need to retranslate that to the dollar. But then your presentation currency, maybe because you locate in Nigeria, or I don't know, is different from the dollar, and you also need to convert. I don't know. The rule, this IS-21, does it also cover translation from functional currency to presentation currency, or is it just from the foreign currency to functional currency?
Fantastic. It covers it. It covers it. The only thing is that that is not the focus. For instance, just like you've rightly said, a company, you are looking at a company whose functional currency is dollar, which means it keeps its accounting record in dollar, right? But it has some transactions denominated in pounds. So as far as it's concerned, those pounds denominated as transactions are foreign currency. So you apply the rule of IAS-21 to translate that amount from pounds to dollar at the date of transaction. If settlement takes place before the end of the year, you apply the appropriate rates. If settlement has not taken place at the end of the year, you determine whether the item is monetary or non-monetary to be able to know the exchange rate to apply, and where the exchange difference will now be recognized. Now, at the end of the year, you want to prepare your financial statement in another currency entirely, say Naira, Nigerian Naira. Which exchange rate do you apply, or which rule do you apply? The same rule that you will apply when you are translating the financial statement of that subsidiary whose functional currency is different from the functional and presentation currency of the group. Which means when you are translating your own financial statement from that dollar to Naira, all assets and liabilities should be translated using what? Closing rate. Your share capital, your share premium should be applied using exchange rate at the date those instruments were issued. And all your post-acquisition, nothing like post-acquisition now, because you are dealing with yourself as an entity. So the profit for each year will be translated using average rate, which is the rate you use in the P&L of each year. So that is what is the same rule that you apply. I hope that answered your question, Samuel, but that is not the focus of the examiner.
Okay, fine. Thank you. That's clear.
Arit, your hand is up. Please go ahead.
All right, sir. So these non-monetary items that is mentioned at revalued amounts, which we are supposed to use the exchange rate at the date of revaluation. So you said the difference between the exchange rate at that revaluation date and what?
Okay. That amount, before you revalued it, it was assuming you revalue it at the end of the year, right? In that foreign currency. Then you translate it, right? The difference between that amount after you translated it and the previous carrying value in your book. Are we together? The previous carrying value at the beginning of the year is what you compare to be able to determine the exchange gain or loss. I mean, you see, if you are using the translated figure, that means the difference you are going to get will be partly fair value gain or loss and partly the exchange gain or loss. But you don't need to separate the exchange gain or loss from the fair value gain or loss because it's not required. Given that wherever the fair value gain or loss goes to is where the exchange gain or loss goes to, there is no point divorcing the exchange gain or loss from the fair value gain or loss. I hope that is clear, Arit.
Very clear, thank you.
Okay. IFRS 11 deals with joint arrangement. Joint arrangement is defined as an arrangement of which two or more parties have joint control. Joint control is equally defined. A joint arrangement of two types, you have joint operation and you have joint venture. Joint venture is accounted for under IAS 28. the same way you account for associate using equity method. But joint arrangement, joint operations, you account for it in accordance with Ifrs 11 by taking your share of income and expenses and recognizing it in your financial statement, by taking your share of the assets and liabilities and recognizing it. Remember, in the case of joint operation, you have right to the assets and obligation for the liabilities. And in the case of joint venture, you have the right to the net asset. So that is all we dealt with. IS-28, this with investment in associate and joint venture. The method we use to account for associate and JV is equity method, which requires that the investment should initially be recognized at cost, and subsequently it should be adjusted up or down to reflect your share of the post-acquisition return and your share of the post-acquisition other component of equity of the associate. Olatoye Kushimo, please go ahead.
Thank you very much. Yeah, I just want to confirm how we determine if the rights are to the assets and liability, or if the rights is just to net assets.
Okay, so the starting point is what type of entity are you dealing with? What type of entity are you dealing with? Or is the joint arrangement structured in such a way that you have a separate vehicle? What do we mean by a separate vehicle? If A and B enter into a joint arrangement, is there a separate vehicle through which that joint arrangement is being carried? If the answer is no, it is one of the two parties. It could be A, it could be B, that is carrying on that business on behalf of both parties. Then definitely that is a joint operation. It can never be a joint venture. But if there is a separate vehicle, say C, this C, for you to know whether it will be a joint operation or a joint venture, you need to look at two things. Number one, the nature of that entity, the structure of that entity. Then number two, other terms and conditions. If it is structured in such a way that, for instance, in this part of the world, let me use Nigeria, if it is not structured as a partnership or as a trust or as an enterprise, definitely is going to be a joint operation. However, if it is structured as a limited liability company, where the liabilities of the partners, of the shareholders are limited to the unpaid portion of the share capital that have been called, then you can say that it's likely to be a joint venture. But you still need to look at all the other terms and conditions given to you by the examiner to determine whether you have the right to the assets and liabilities, which should be a joint operation, or the right to the net asset, which should be a joint venture. I hope that is clear.
Yes, it is. Thank you.
Okay, so as 28 have said, we use equity method to account for it. Okay, I don't know whether Arit, your hand is up.
Yes, sir. Okay, please, in equity accounting method, unrealized profit from inventory and non-current assets is deducted from equity if is deducted from the computation if associate is the buyer. Why is that? The same thing with dividend received from associate is deducted. Why is that, sir?
Okay, you are actually asking two different questions. You say when parent sells inventory to associate, and there's an unrealized profit that has been calculated to the extent of the percentage that parent has in their associate. In that case, that unrealized profit, the way we do the treatment is we are going to debit consolidated returning, and we are going to credit it to what? We are going to credit it to investment in the associate. The simple reason is that the inventory is not in the group account. The inventory is in the book of the associate. Remember when we are dealing with unrealized profit in the transaction between the parent and the subsidiary, the unrealized profit is always credited to the inventory to reduce the inventory. But when the buyer is the associate, you don't consolidate the assets and liabilities of the associate. So you are not consolidating the inventory of that associate. So there's no way you can credit the inventory of the associate. So the only place you can credit is investment in associate. That is the reason. Now for dividend, we've said that you will take your share of the profit after tax and you will recognize one leg in investment in associate. The other leg, you recognize it in P&L. The associate has declared profit or dividend out of that profit. So taking your share of the dividend and also recognizing it in P&L will amount to double counting. So the accounting treatment using equity method for dividend received in the associate is for you to debit cash and you credit investment in associate. You will not credit P&L, but you credit investment in associate. Because already you have taken your share of the profit after tax of the associate. So recognizing dividend that has been paid out of that profit will amount to double counting, which will not make sense. I hope that is clear.
Yes, that is clear, except that the accounting treatment was fast. That is clear, sir. Thank you.
Fast, Arid, you are not an international student. Check your slide, check your handout. All the accounting entry is there.
Thank you, sir. Thank you.
Okay. I think, what I would like to do is to actually attempt the question that we have in that the question has been shared with everyone, I'm sure, showing the various things we are doing today. I would like us to look at that question, the first one, the first question. You all have the question, right?
Yes, it was shared.
Can you please read that question?
Sir Jami, good morning. What question, please?
Under question one. Question one.
I'm not sure that anything was shared. I'm not sure.
It's been shared on a group WhatsApp that was curated, and I'm sure for the regular student it's been shared on your WhatsApp.
I don't think so, sir, for the face-to-face class, sir.
And you guys are not in that. Okay, so let me share it. I'm surprised. I'm surprised why it wasn't shared with you guys. So this slide I'm representing was not shared. I've sent the.
Hello, do you mean bike lights?
You said? I've just shared it.
Bike light.
Bike light. Cabis. The first thing you have there is cabis.
Yes, it was shared in the WhatsApp group. Yes, we have it.
Okay, so I've shared it. I've shared it now. Can you please quickly go ahead and read?
Sorry, I think for some of us, the group page was already full, so we couldn't join. So I don't know if the question can be displayed and we could just take a screenshot so that we can follow as you solve the question.
You said the group page? I don't understand that.
The WhatsApp group page was already full. So for me, I think WhatsApp only accommodates 257 participants. So it was already full, so I couldn't join the WhatsApp group page. So I was asking that, is it possible that we display the question and we just take a screenshot so that we can follow your class?
Okay, I will try and do that.
All right, thank you very much.
Alternatively, I'll drop my number on the chat group, on the chat as space. Please, you can private chat me. I will add you to a group and then share the question with you.
Okay, that works too. Thank you.
ban kala way da la kuina da la ku.
Oh, please go on mute. Everyone should go on mute, please. Everyone should go on mute. So the way I would like this to be done is someone should read the question for us. Someone should read the question for us. Bukola, your hand is up. Can you please go ahead? Not sure if you guys can see yes, you can see my screen. You can see the question now. Someone should read the question for us.
Please, I do not have the question. Can you put it on WhatsApp, please?
Which WhatsApp? Which WhatsApp? Because it's been included in the 2 WhatsApp group that we have internally. The other WhatsApp group I'm not there, so I don't know whether it's been. So which WhatsApp group are you talking about? Can someone help us?
Jamie, so some WhatsApp group was created, but some people
are what?
Hello, Jamie.
I can't hear that.
J21.
Yes.
It was changed to something J21 this morning.
Hello, Jamie. Hello, Jamie.
Yeah.
Can you hear me?
Yes, I can hear you.
Please just go ahead with what you have projected. If anyone needs it and you don't have it, just take a screenshot of what you see here. This is the question. So we avoid all this forth and back on WhatsApp.
Okay, thank you. Ari, can you help us read the question? Ari.
Prepare an explanatory note for the required. Prepare an explanatory note for the directors of CABIs, which addresses the following issues. 1. What is meant by an entity's presentation and functional currency? Explain your answer with reference to how the presentation and functional currency of backlight should be determined. 2. A calculation of the goodwill on the acquisition of backlight and what the balance would be at 30th September 20x6, immediately before the disposal of the shares. Your answer should include a calculation of the exchange difference on goodwill for the period from January 1st, 20x6 to 30th September 20x6. 3, an explanation of your calculation of goodwill and the treatment of exchange differences on goodwill in the consolidated financial statement. You do not need to discuss how the disposal will affect the exchange differences. Note, any workings can either be shown in the main body of your explanatory note or in an appendix to the explanatory note. B, explain why exchange differences will arise on the net asset and profit or loss of Backlight each year and how they would be presented within the consolidated FX. Your answer should include a calculation of the exchange differences which would arise on the translation of Backlight, excluding goodwill, in the year ended 31st December 20x6. C, calculate the group profit or loss on the disposal of Backlight. Briefly explain how Backlight should be treated and presented in the consolidated FX of Carbides for the year ended 31st December 20x6. Okay, so I go to the question. Background. Carbides is a parent company of an international group which has a presentation and functional currency of the dollar. The group operates within the manufacturing sector. On 1st January 20x2, Carbides acquired 80% of the equity share capital of Backlight, an overseas subsidiary. The acquisition enabled Carbides to access new international markets. Carbides transfers surplus work in progress to Backlight, which is then completed and sold in various locations. The acquisition was not as successful as anticipated, and on 30th September 20x6, Carbides disposed of all of its holding in Backlight. The current year end is 31st December 20x6. Backlight trading information. Backlight is based overseas, where the domestic currency is the dinar. Staff costs and overhead expenses are all paid in dinars. However, Backlight also has a range of transactions in a number of other currencies. Approximately 40% of its raw material purchases are in dinars and 50% in the yen. The remaining 10% are in dollar, of which approximately half were purchases of material from Carbides. The ratio continued even after Carbides disposed of its shares in Backlight. Revenue is invoiced in equal proportion between dinars, yen, and dollars. To protect itself from exchange rate risks, Backlight retains cash in all three currencies. No dividends have been paid by Backlight for several years. At the start of 20x6, Backlight sought additional debt finance. As Carbides was already looking to divest, funds were raised from an issue of bonds in dinars, none of which were acquired by Carbides. Acquisition of Backlight. Carbides paid dinar 100 million for 80% of the ordinary share capital of Backlight on 1st January 20x2. The net assets of Backlight at this date had a carrying amount of dinar 60 million. The only fair value adjustment deemed necessary was in relation to a building which had a fair value of dinar 20 million above its carrying amount and a remaining useful life of 20 years at the acquisition date. Carbides measures NCI at fair value for all acquisitions, and the fair value of the 20% interest was estimated to be dinar 22 million at acquisition. Due to the relatively poor performance of Backlight, it was decided to impair goodwill by dinar 6 million during the year ending 31st December 20x5. Rates of exchange between the dollars and the dinar are given as follows. 1st January 20x6, $1 to 0.5 dinar. Average rate for year ended 31st December 20x5, $1 to 0.4 dinar. 31st December 20x5, $1 to 0.38 dinar. 30 September 20x6, 1 dinar to 0.35 dinar. Average rate for the 9-month period ended 30th September 20x6, $1 to $1 to 37 dinar. Disposal of Backlight. Carbides sold its entire equity shareholding in Backlight on 30th September 20x6 for $150 million. Further details relating to the disposal are as follows. Carrying amount of backlight net assets at 1st January 20x6, Dyna 48 million Dyna. Backlight loss for the year ended 31st December 20x6, 8 million Dyna. Cumulative exchange rates gains, cumulative exchange gains on backlight at 1st January 20x6, $74.1 million. NC high in backlight at 1st January 20x6, $47.8 million. Thank you.
Thank you very plenty. Thank you very plenty. That was pretty fast. So this is a question that the entire marks it carries is about what? It carries about 30 marks. It's a 30 marks question, similar to the one you will see in the exam. So IAS 21 is being examined here together with the other group related standard. Bukola, your hand is still up. I assume it's the hold hand. Can you go on mute? I mean, sorry, can you lower your hand if it's still the same hold hand? So I'm sure you've taken the picture of the question when she was reading. I'm sure you've taken the picture in case you've not. I'm showing it again. Bukola, you can lower your hand, like I've said, so as not to cause confusion. Okay, so in the first part of the question, it says, prepare an explanatory note for the director of Carbides, which addresses the following issues. One, what is meant by an entity's presentation and functional currency? So that is an explanation. That means they wanted to define and explain what it's not just to define. Yeah, you will define, but it's not just to define each of them, but you need to explain. So you need to add additional point. Explain your answer with reference. So you need to now relate it to how the presentation and functional currency of Bakelite should be determined. That is a 7-mark question. So before we deal with the second part, let's go ahead and deal with that part first. Let's go ahead and deal with that part first. So what is functional currency? I've defined it before. So in order to save time, given the amount of the additional things we have to do today, I would like to suggest that when it comes to the narrative or explanation, I will just explain. If you have questions, I will attend to that, but I will not type them here. I won't type it here because I can send you, they will send you the solution, the narrative, especially the narrative. But the calculation we can easily do, as that one should not take too much time. So presentation currency is the currency in which your financial statement is presented. Ideally, the directors should be at liberty to choose the currency they want for the purpose of presenting the financial statement. For the people in Nigeria, you know that the decision to use presentation currency is no longer at the discretion of the directors, because we've got a regulator in Nigeria called the Financial Reporting Council, which has limited or restricted the ability of the directors to choose presentation currency, because that FRC issued a rule that says all financial statements prepared by entities in Nigeria should be in what? In Naira. However, if you're an entity that is operating in another jurisdiction other than Nigeria, where there is no such restriction, you can choose to present your financial statement in any currency you like. So the director of this company, they should be at liberty to do that. The functional currency, on the other hand, is the currency of the primary economy environment where an entity operates. And when I was revising IS 21, I mentioned the first 3 factors you should use to determine or identify your functional currency. And you were told that when those 3 cannot help you to identify your functional currency, then what should you do? You should use 2 additional factors. If we go back to the scenario here, it says Cabais is the parent company of an international group which has the presentation and functional currency of the dollar. The group operates within, so the functional currency and the presentation currency of the group is dollar. The group operates within the manufacturing sector. On 1st January 20X2, Cabais acquired 80% of the equity share capital of Beckerlite, an overseas subsidiary. So that is a foreign subsidiary. The acquisition enabled Cabais to access new international markets. Cabais transfers surplus work in progress to Beckerlite, which is then completed and sold in various locations. That is something you have to take into consideration. But is that enough? I highlight that in yellow. The acquisition was not as successful as anticipated, and on 30 September 20X6, Cabais disposed of all its holding in Beckerlite. 20X6, that is almost 4 years. The current year end is 31 December 20X6. So you have 20X2, X3, X4, X5. So that subsidiary was held for like 4 years, 2, 3, 4, 5, 6. It was held for 4 years and 9 months before it was sold. Beckerlite trading information. Beckerlite is based in overseas where the domestic currency is the dinar. Yes, that is the currency dinar, okay? Staff costs and overhead expenses are all paid in dinars. That is something you need to take into consideration. Staff costs and overhead paid in dinars. However, Beckerlite also has a range of transactions in a number of other currencies. Approximately 40% of its raw materials purchases are in dinars. 50% in yen, Japanese yen. Then the remaining 10% in what? In dollar. Of which, that 10% that is in dollar, of which approximately half were purchases of raw materials from what? Cabais. Okay. The ratio continued even after Cabais disposed of all its shares in Beckerlite. Revenue is invoiced in equal proportion. That is another information you need between dinars, yen, and dollars. So that means when invoice is being raised, it's raised in 3 different currencies. 1/3 of the invoice is raised in dinars. 1/3 of the invoice is raised in yen and 1/3 in dollar. So protect itself from exchange rate risk. Beckerlite retains cash in all 3 currencies. Interesting. No dividends have been paid by Beckerlite for several years. At the start of 20X6, Beckerlite sought additional debt finance. As Cabais was already looking to divest, funds were raised from an issue of bond in dinars. In dinars. None of which were acquired by what? Cabais. None of which were acquired by Cabais. So I think the information we need to be able to answer the A1 part of that question, that carries how many marks? The A1 that carries
7 marks.
7 marks.
7 marks. Those are the one I highlighted in yellow. So as you are writing the exam, you should be highlighting what you need to be able to answer that question. You should be highlighting them as you are going through the question. So if we are now applying this in solving the question, so we've defined functional currency, we've defined presentation currency. It now says explain your answer with reference to how the presentation and functional currency of Berkeley should be determined. So with regards to how presentation currency should be determined, take note, the directors of Bakelite are at liberty to determine the currency in which they present the financial statement, unless the law of that country, just like that of Nigeria, compels them to prepare that financial statement in a particular currency. So they are at liberty. That is the simple answer to that. Now, with regards to A, you can take note of the picture because I want to change to Excel now. I want to change to Excel. So you have A1. A1 is the one we are answering now. And you know, for the purpose of the examination, you guys will use resources, which I want to believe by now you all are familiar with. It's not, the June exam is not paper-based. I'm sure we all know that. It's going to be a computer-based exam where the resources you will use, the spreadsheet you will use will be similar to Excel, with the exception of few things, such as you cannot insert rows and you cannot insert column. So A, so I will just say determination of functional currency. Okay, so I want to start projecting the Excel now. And I'm sure you can see my Excel. We say determination of what? Determination of functional currency of light. Okay, so looking at the first three factors, the first factor says currency, the currency in which the invoice is raised, the currency in which the invoice is raised. That is the currency that influences the sales price, currency that influences the sales price of goods/services. Goods. What this company sells is gold. So that is the currency in which invoice is raised. So in that case, is partly yen, partly, you remember the question says partly yen, right? Partly USD and partly what? Partly dinars. Yes. So you can see that currency, that first factor is not supporting a single currency, but it's supporting about three. The second one says the currency of country whose regulation and so on and so forth, competitive forces. Do they give us any fact in the question that would make us to apply that? I do not think so. I do not think so. Can anybody say anything in the question that talks to the fact that that factor is being tested? I don't think so. I can't see it. If you can see, let me know. Then let's move to the third one. So you don't need to waste your time too much on the factor. Okay, Samuel, your hand came up and it went away again.
Yeah, but I was going to add that the fact that the entity operates in the country that uses the DAI now, isn't that to suggest that the entity will be subject to any laws or competitive forces in that country, or an indication to that effect?
It's not cast in stone. It's not. It may be like that. It may not be like that. For instance, for banks operating in Ghana, I'm sure they are subjected to the regulation of the Ghana Central Bank. Then you can say that it is the competitive forces in Ghana that will influence the sales price of the goods or services, of the services being provided by those banks in Ghana. However, for oil companies operating in Nigeria, for the like of Chevron, for the like of Mobil, ExxonMobil, yes, they operate in Nigeria. But do you think it's the competitive forces that, do you think they are competing with when it comes to the price of crude oil? No. It's no. Do you think is the regulation here? Yeah, they can regulate price of crude oil here, but what happens, the regulation here cannot necessarily determine what the price of crude oil will be. So in most cases, it could be, yes, but not in all cases. If you say yes, because it operates in that country, it is going to be influenced by the regulation. Yeah, that may be correct. May be influenced by the regulation in that country. That may be right to a certain extent. And if that is right, that means it is going to be DINA. That factor will support DINA, but not in all cases. Then the third one says the price in which material costs, labor costs, and overheads are denominated. According to the question, you know that is partly in different currency, right? It says 40% of his raw material. No, before then. It says staff costs and overhead expenses are all paid for. Staff cost and overhead. So that means labor cost, right? So of the three of them, staff cost and overhead expenses are all paid for in DINA. Staff cost and overhead expenses. All paid for what? In DINA. That one support DINA. Then, when it now comes to material cost, see an extension of this third one. See an extension of this third one. Material cost. That is 40% is paid for in what? In DINAs. 40% in DINAs, comma, 50% in what? 50%
yen.
In yen. And the balance of 10% in what? In USD.
USD.
In USD. And that USD, we were told that half of it. So like you say, you may want to argue here that the second point, so you may argue that given that the company operates in a jurisdiction where DINA is spent, then the regulation of that country influences the sales price. So in which case it becomes what? In which case it becomes DINAs. You can put forward that argument. You can put forward that argument. So don't just keep quiet. Write as much thing as you think makes sense to you. Yes. Okay. But those are the three main factors. But we're given two additional factors that I think we can use here that we should not keep quiet on. if you go to those things I highlighted in yellow, it says this company raised debt. Okay, on the basis of the three, with the first three, can we conclude what the functional currency is? With the first three here, can we conclude what the functional currency of Bakelite should be? What do you think? Yeah, we can conclude that it should be diners, but don't just stop at that. Use the other information given to you to be able to support your position. Remember, it says 2 additional factors, right? 2 additional factors. And the 2 additional factors include, 1, in which currency do you retain the funds that you obtain from operations? So that one is neither here nor there, you know. That one is saying that you retain its currency in which fund from operation is retained. And that is in those 3 in yen, dinars, and what? And USD. So that one is not really helping us, because that one is actually saying that it retains is fund from operation in those 3 currency. And the last one I'll say, recently this guy has raised finance. In which currency is finance raised? And that is what? In dinars. So this is sufficient to help us to conclude that definitely from all available facts. You know, you will discuss all this. You are not going to put them in bullet point the way I've put them, but you will discuss them. But make sure that you touch all these points. That is why I'm highlighting the point for you. So you will discuss all the points. You will discuss all the points. You were equally told when I was revising today that for the subsidiary of a multinational company that operates in another jurisdiction, for instance, assuming the parent company is here in Nigeria, the subsidiary is there in Ghana or in South Africa. So the subsidiary in South Africa and Ghana equally needs to determine its functional currency. What should it be? Should it be the South Africa rands, or should it be the currency of the parent here in Nigeria, which is Naira? So for you to decide, the standard gives 4 additional factors, but those 4 additional factors are complementary to the one we have here. But all those 4 additional factors are pointing to the fact that is that subsidiary enjoying autonomy, or is it an extension of the parent company? You know, we were told that the parent company transfers surplus work in progress to Bakelite, which is then completed and sold in various locations. That may suggest that the material, what is sold, is coming from what? Is coming from the parent company. So you need to touch on that point as well, but you will not use it to conclude. You touch on that point, but you won't use it to conclude. Because if the subsidiary cannot sell until it has got work in progress from its parent company, which it will finish and sell, is suggesting that is to a certain extent is dependent on the parent company. But is that enough to change your mind? That shouldn't be enough to change your mind. The question is, does this company still enjoy high degree of autonomy? If you look at it, when it was raising finance, it raised finance bonds in dinars, both during the period that Cabais has interest in it, and even after, it still has that, it continues to do that. What do you think will be our conclusion here in terms of what the functional currency should be on the basis of all these facts? What do you think?
That the functional currencies.
Okay. So the functional currency should be what? Should be dinars. Should be dinars. Okay. It should be dinars. So you will discuss all this, you won't just, all those things I highlighted in yellow in the question, they are the fact that you need to use in supporting your position. Having said that, if you move to the second part of the question, which is A2. A2 says, a calculation of the goodwill of the acquisition of Bakelite and what the balance will be at 30 September 2026, immediately before the disposal of the shares. Your answer should include a calculation of the exchange difference on goodwill for the period from 1st January 2026 to 30th September 2026. Remember, because the functional currency of Bakelite is dinar, and the functional and presentation currency of the group is US dollar. Then, given that the presentation currency of that Bakelite is likely to be dinar as well, its books, which are kept all in dinars, should be translated to dollar. Its financial statements should be translated to dollar, following the rules that we've talked about. The goodwill should originally be calculated in US dollar. That is the rule of IS 21. Then you will translate it. You will translate it to what? You will translate it to US dollar. Maybe we can quickly do the calculation of the goodwill, after which we can go on break and we come back to continue. So let's do the calculation of the goodwill and the translation into what? Into, so A2, I would say calculation of goodwill at acquisition date of Bakelite. That is on 1 January 20x2. So in doing that calculation, remember it should be done in that foreign currency, which is dinar, in millions. So in calculating goodwill, you need 3 items. But before I go ahead and do the calculation, you remember in the question, we were told that Carbon paid diners 100 million for 80% of the ordinary share capital of Bakelite on 1st January 2022. The net asset of Bakelite at this date had a carrying amount of 60 million dinars. The only fair value adjustment deemed necessary was in relation to a building which had a fair value of dinars 20 million above its carrying amount and a remaining useful life of 20 years at the acquisition date. Cabot measures NCI at fair value for all acquisition, and the fair value of the 20% interest was estimated to be dinar 22 million at acquisition date. Due to the relatively poor performance of Bakelite, it was decided to impair goodwill by dinar 6 million during the year ending 31 December 20x5. So rate of exchange between dollar and dinar were provided. Yes, they were provided. Now, to calculate our goodwill, we are using fair value method. To calculate goodwill, you need 3 items. Number 1, you need the fair value of the consideration, which has been given as 100 million dinar. The second thing you need is fair value of non-controlling interest at the date of acquisition. That has been given here as 22 million. The third item you need is the net assets of the subsidiary at the date of acquisition, right? We were told that the book value of the net assets at acquisition day was 60 million. But they now said there is an upward fair value adjustment as a result of the application of Ifrs 3, which leads to upward fair value adjustment of 20 million on building. And doing that means the net asset, the real net asset, the fair value of the net asset at acquisition date will be the 60 million plus 20, which will be 80 million. So let's go ahead and do the calculation. But take note, you must calculate it in the foreign currency. So we say the fair value of consideration. You can see my slide as I'm typing. That is 100 million. The next item is fair value of NCI at acquisition date. And that is given as 22 million dinars. We sum up the two figures, and that gives us 122, right? It gives us 122. If you have any question, please raise your hand. Then the next thing is fair value of net asset of subsidiary, right? Which is at acquisition date. At acquisition date. You guys may possibly know another format. You know there's another format of calculating goodwill other than the one I'm using. The one I'm using is the new format mentioned specifically in Ifrs 3. But you know there is another format that we were using in those days before Ifrs 3 came on board. But we will arrive at the same thing if we use it. So remember, the fair value of the net asset should be obtained by, saying the fair value, the book value of the net asset, which is 60, plus 20, which is the upward fair value adjustment. That gives equal minus 50 plus what? 20. And that will take us to the amount of the goodwill. So we can see goodwill is very simple to calculate, which is 42. That is our goodwill at acquisition date. At the date of acquisition, which is 1 January 20 x S2. Yes, that is the goodwill as at that date. If there is no question, then let me now do remember they gave us information regarding the fact that goodwill was impaired in the 4th year, which is 20x5. Remember the first year is 20x2. The second year is 20x3. The 4th year is 20x4. And the 4th year is 20x5. So that was the year the goodwill impaired. But we've calculated this goodwill in currency dinars. We need to now do the translation. So in doing the translation, I'm going to say, when we finish this, we'll go for a short break. So continuation, I will say translation. Translation of goodwill. Translation of goodwill that arose in what? In backlight between acquisition date and what? Reporting date. We want to do that translation between the date of acquisition and reporting date. So if I remove this one here, then here this will be exchange rate, and this will be in dollar, right? In dollar. In dollar. Feel free to ask any question by raising your hand. Okay. I want you guys to pay attention to this. George Okorie, your hand is up. Please go ahead.
Yes, Jamie, thanks. Please, can you recap on why we are translating the goodwill? I'm not sure I caught that to dollars.
Okay, IS 21 says goodwill. Remember that when they give you the financial statement of the subsidiary, you will not see goodwill there, right? It is only when you are preparing consolidated financial statement that goodwill will arise. But remember when I told you how the financial statement of the subsidiary should be translated? We said all assets and liabilities should be translated using closing rate, which is the rate ruling at the reporting date. IS 21 specifically requires that the goodwill that arose on a foreign subsidiary should be treated as, in quote, as if it's part of the asset of that subsidiary. And as such, it should first be calculated in that foreign currency, and it should be retranslated into the presentation currency at the end of every year. It should first be calculated in that foreign currency, and it should be retranslated into the presentation currency of the group using closing rate at the end of every year. So it's a specific requirement of IS 21, and that is what we want to apply. I'm sure that is clear, George. So
yes, sir,
I would say goodwill at 1 January 20x2, right? You remember the amount there is, so I don't need to be putting this here. The amount of the goodwill we calculated there is 42. So as at the date of acquisition, do you know how much the exchange rate was as at the date of acquisition? What is the exchange rate between dollar and pound, and dinars? How many dinars make $1 as at that day, based on what you saw in the question? Can you see it?
$1 to
$1 to
0.5 dinar.
0.5 dinar.
$1
0.5 dinar to $1.
$1, right? So I'm going to say 0.5. Am I going to, in translating this to dollar, am I multiplying it or I'm dividing it? What do you think? Because this is another important thing.
You are multiplying.
Multiplying. Multiplying.
Dividing. You're dividing it.
Dividing.
You're dividing it.
Sorry,
You
you
are
are
dividing.
dividing.
You are dividing.
You are dividing. You remember when you are in the exam, you are on your own, nobody is there to really help you decide on whether you need to divide or
multiply.
How do you think you should figure it out?
I think the dollar is supposed to be lower. So
we are saying, remember we are translating from dinars to dollar.
You are dividing.
Which of the two currency is stronger based on what we are seeing as our 1st January 2022?
I think dinar is
Dinar is stronger.
Stronger.
Dinar is stronger.
Exactly. We are saying 0.5 dinars. 0.5 dinars make what? Makes $1. That is what you are saying. So imagine somebody gives you that dinar. This is how you should get it. Somebody gives you 1 dinar. You are based in US and your currency is US dollar. Somebody gives you 1 dinar. If you want to exchange it into dollar, how much do you expect the Buridichan to give to you? Somebody gives you one dinar. How many dollars do you expect them to give to you?
$2.
$2.
$2.
You know, that means you are dividing, right?
Dollars.
That means you are dividing
Yes.
diners to be able to get the dollar.
Yes, we are dividing. Yeah.
So you are dividing. Please take note. It gives you 84. It gives you 84. So at that date, that is the dollar amount of the goodwill. Remember, there is no exchange, no impairment loss until when? Until 31 December 20X5, which is the 4th year. So I will come here and say impairment loss for the year. And that it occurred in that year, 31 December 20X5. And it's going to be in jacket here, 6 diners. 6 diners. So which exchange rate do you think we should use to translate that? Which exchange rate?
Average rate.
0.38.
Average rate.
0.4.
0.3.
Listen and listen good, guys.
It should be the rate at 31 December 2015, 2085.
Listen and listen good. The impairment loss on goodwill, where does it go to? Is it a P&L item or not?
P&L.
According the expectation of IS 21 is what goes to P&L or OCI should be translated using average rate. Is that clear?
Yes.
What goes to P&L or OCI should be translated using what? Average rate, not closing rate. Take note of that. So what is the exchange average rate for that year ended 31 December 20X5? What is the average rate, please? Based on what you can see in the question, what is the average rate?
0.4.
0.4.
0.4.
So in our usual way of dividing, so we divide 6 by 0.4. That gives us 15, right? That gives us 15. Right? So there will be an exchange difference. There will be an exchange difference. But you guys are not asking me, what about the exchange difference for that year? But I'm going to show you. Just relax. Relax. Because at that same end of the year, we need to now translate, right? We need to translate using closing rates. Whatever we have in our book should be retranslated using closing rate. You know, the balance of goodwill in our book is 36, right? In diners. But it should be translated, given that that is an SFP item, it should be translated using closing rate based on what I've told you before. So I will say impairment loss. Sorry, exchange difference, not impairment loss. Exchange difference. That is going to be a balancing figure. Please clearly pay attention here. Then it's going to be a balancing figure. So because it's a balancing figure, nothing here. So, but there will be figures on these two sides. So the figure here, which is the closing balance, is going to be that is goodwill in the SFP at 31 December 20x5. Okay. What is the closing rate as at 31 December 20x5? Closing rate.
0.38.
Okay. Do we? Yes. 0.38. That should be the rate we should use to translate. That should be the rate we will use to translate for the SFP purposes. Right? I hope you understand the way I'm doing it. So we'll divide this by this. That is 36 divided by 0.38 gives us 95. So the goodwill in our SFP should be how much? It should be 95. But after translating the impairment, and we arrived at 15 and we took 15 away from 84, we got almost 69. So 69 was the balance after deducting impairment loss. But the goodwill in our SFP is 95 in dollar terms. Definitely, whatever be the difference between that 95, which is what we should have in the SFP, and that 69 represent what? It represents
Exchange gain.
the amount that should be treated as what? Exchange difference. Let me put, it's not a round figure. Yes, that is the exchange. Is it a gain or a loss? Is it an exchange gain or a loss?
It's a gain.
Again.
Again.
Because it is an asset, and any exchange increase, any increase in an asset in form of exchange difference will be a gain. But remember, we've not finished. The date of disposal is 30th September 20x6. So we should be able to do the calculation up to that point. And in fact, that is exactly what the question says. It says, your answer should include a calculation of the exchange difference on goodwill for the period from 1st January 20x6 to 30th September 20x6. So we want to, at the end of 20x5, the closing balance is 95. That is what we will, in dollar terms, that becomes the beginning balance in 20x6. Then we will do a similar calculation in 20x6 up to 30th September to determine what the exchange gain or loss will be, because the exchange rate has kept on changing. Ahmed Popola, your hand is up, please. Go ahead.
All right, thank you. So, we say we use the average exchange rate for item of POL. So I want to know, when do we use the exchange rate at transaction date? Is it not for POL as well?
Okay. On the day you first entered into that transaction and you are about to record it in your book, the exchange rate you should use that day should be the rate, the spot rate as at that date, right? It should be the spot rate as at that date. But now we are talking of an item that is carried in your book as an asset. And there is a movement that is impacting that item in form of impairment loss. You know, for PPE, it will be depreciation. For PPE, what is impacting, one of the things that is impacting movement in PPE is depreciation.
Jamie, you're on mute.
You are muted.
Someone muted me. Oh, can you hear me now?
Yes.
Perfectly, sir.
Someone muted me. I said, supposing this goodwill is a PPE, property, plant, and equipment. What are those movements that we see in PPE? Depreciation, right? Where does depreciation go to? P or L. So if this were to be PPE, that depreciation should be translated using average rate as well. What other things cause movements in PPE? Impairment. PPE too can impair, right? That impairment loss too should equally be translated using average rate like we've done here. What else can cause movements in PPE? Revaluation gain or loss. Gain goes to OCI, loss goes to P or L, right? Again, those one too should be translated using average rate. But the balance at the end of the year that will sit in your SFP, that is the one you should translate using closing rate. So transaction date is different from movements during the period. And I hope that is clear. Kristen.
Yes, it does. Thank you.
Kristen, your hand is up. Please go ahead.
So, Mr. Jami, if we had used the other approach of calculating exchange difference, the one you do goodwill at this year closing dates and goodwill at last year closing dates, will you have gotten the same answer with this?
No, you know that one is okay. We will get the same answer. I understand what you are talking about perfectly well. However, we will get the same answer, but when there is impairment loss, you need to break the calculation down like this. I don't know whether you get me. The one we did in the class that you referred to, goodwill at this year closing rate, goodwill at last year closing rate. That is when we are trying to calculate the total exchange difference between acquisition date and reporting date for the purpose of inclusion in the consolidated SFP as part of the total exchange difference. But this one, there is an impairment loss. You need to be careful. You need to first translate the impairment loss using average rate. Then whatever be the difference between the translated goodwill after that impairment loss and the goodwill at the end of the year translated using closing rate is also, that is the exchange difference you will get. So it will be calculated differently when you have impairment loss. I hope that is clear. Munyolua.
Yes, sir. So I know that for every year, since acquisition, there has to be exchange difference. You have to calculate exchange difference. So what was the reason why we didn't calculate exchange difference from say 2003, 2003, 2004? Because of it was not given.
Okay, you are right. Good, it should be translated. That goodwill should be translated at the end of every year, right? Based on what I've told you before, they should do the calculation at the end of 2012 to know the exchange gain or loss on that day. They should do it at the end of 2013 to know the exchange gain or loss in that year. They should do it in 2014 to know the exchange gain or loss in that year. But I'm not sure we were given exchange rate at the end of 2012, 2013, and 14, right? We were not given.
Yeah. We are not giving it.
We were not given. So the examiner doesn't want us to waste our time. But if you had been given, let me tell you something. If you had been given, let me tell you the secret. Let me tell you the secret. If you had been given at the end of 2012, 2013, 2014, right? Before they gave us that of 2015. Do you know what will happen? You will calculate in 2012. It could be a gain or loss, depending on what the rate they give to us is. You will calculate in 2013. It could be a gain or loss. You will calculate in 2014 before you come and do that of 2015. Now, given the exchange rate given to us at the end of 2015, when you had exchange difference in 2014, 12, 13, 14, and 15 together, it will still be equal to this 25.74. I don't know whether you get that. It will still be equal to this 25.74.
Wow.
Add all of these. Yes. You know what? You can reset the question for yourself by just assuming any exchange rate as at 31 December 20x2, 20x13, 20x14, S4. Use any different exchange rates. Do the calculation year by year. Then add all of them to that of 20x5. You will see that the cumulatively they will be equal to 25.74. Okay, let's do for 20x6 because specifically we were asked to do it up to 20x. So 31 December 20x5 is the same thing as 1st January 20x6. You will agree with me, right? I will now leave a space and say exchange difference, which is going to be a balancing figure as well. It's going to be a balancing figure as well, right? Then we come here and say goodwill at 30th September 20x6, right? 20x6. Remember, that is the one we want to translate. Using what? The rate as at that day of 30th September. So there is nothing here, no impairment loss again. So the goodwill of 36 we have, the previous year is the same one we have as at that day. The exchange rate we have as at 30th September 20x6 is how much? What is the exchange rate that we have as at that day?
0.37.
0.37. Okay, do we all agree? Are you sure it's 0.37? Everybody should check.
Is 0.35.
Sorry, 0.35.
Is 0.35.
0.35.
Where are you getting in? Let me be sure. I can't see it here. Where is it provided?
0.37 is the average rate. 0.35 is closing rate.
Okay, yes. 0.35. So the average rate for that 9 months is 0.37. Yes, 0.35. 0.35. Okay, so we divide, as usual, we divide 36 by that 0.35. So that gives us 103, right? 103. So let's then the difference that we have here, is going to be a balancing figure, which is what? 8 point something, 8.12. Yes, that is the exchange difference. How many marks does this part of the question carry? Well, just 5 marks. It's 5 marks that has been wasting our time since. I'm sure if you are in the exam hall, you should be able to figure it out on your own. So that is the end of A2. I think we should go on break now. We should go on break for like, I think we can do 25 minutes. Let's go on break for 25 minutes. Then we come back by Nigerian time, that is 12:33. By 12:33, we come back. For the others, you can look at what the time is at your end, but we'll come back by 12.
Sorry.
Okay.
Is it 8.2? The balancing figure. I got 7.86.
No. This figure is 94 point something.
No,
Let me increase
8.12.
It's 8.12. 8.12. So break has started. We'll come back by 12:30. I think the admin can stop recording. They can stop recording for now. So see you by 12:30.
There's another break by 1, according to the timetable.
You know, we have varied the timetable now. We vary the timetable. This is the one we are following. Right?
Okay.
Thank you. See you by 12:33. Thanks.
Hello. Hello.
Yes.
Yeah, I can't hear anyone talking, so
No,
I
he
was
said
thinking
that
class. Huh?
there's a break time, I think. Yeah, for 25 minutes. He'll be back in 25 minutes.
Pardon?
He said that there's a break time. He'll be back in 25 minutes.
Oh, thank you.
Welcome.
These people did not stop the recording. Hello, we are welcome back. We are welcome back. We want to start. We want to continue from where we stopped. We want to continue from where we stopped. I would like to continue from where I stopped. I'm sure you guys can hear me. Please confirm you can hear me.
Yes, we can hear you.
Yes, we can.
Okay, so let me quickly do something here. This impairment loss, let me quickly insert a comment here to let you know something.
Hi, Mr. Jamiu.
Yes, you can hear me?
Yeah, hi. Please, I have a question just before we went for break. The exchange rate we used to translate